Hi, folks, and thanks for joining us here at Street Smart Options for another great video. Tonight, we're going to be talking about options trading income. And, folks, if you haven't already checked us out on the Facebook group, you can go over to Facebook and join our group for free, where we do free posts, very much like this video right here. But we're also putting other information in about how trading works and how you can make money with stock options trading. And, we actually have an entire piece of the course. It's actually a bonus add-on that we give to you when you register and take the full Street Smart Options training course. And that is a course that covers how to make income from trading stock options. And that's the tenets of it, the basic reason for that piece of the course. I'm going to let Jonathan explain a little better. Jonathan, go ahead.
Thanks, Jim. So, yeah, we offer a course called Options Locomotive, which is a bonus to the Street Smart Options course. And it's all about options income, how to make income from options trading. And so I'm going to talk about that today. And obviously I can't go into, we don't have enough time to go into all the details in that course, but I will cover a lot of the highlights. So we have in front of us, the S&P 500. And one of the things you want to keep in mind when you're trading for income is consistency, right? You don't want to be losing money. You want to just be making consistent amounts of money over time. And there's three ways of doing that, or three ways I like doing that. There's more than three ways, but three ways I like doing that. And one is you can sell covered calls, and I'll go into that a little bit. You can sell naked puts, and there's safe ways of selling naked puts, and you can also do bull call spreads. And so first, let's just look at maybe doing the covered call strategy. So a covered call is simply you have a stock that you like let's say you like the company Visa, right? And the thing you want to look at in a selection like this is you really want to have a stock that you can latch onto for a long period of time. So you want a company that doesn't have a lot of volatility in the chart. You want something that has, over a long period of time, shows steady upward price action to do the call selling on. And if you do call selling on a stock that is has low volatility and is in a steady uptrend over a long period of time, you're going to win more than lose. You're putting probability on your side. So that's the number one thing with selling covered calls is picking the right underlying stock. You really want to pick a stock that is quiet, and not sideways quiet, but upward trending over a long period of time and without a lot of wild swings in it. Compare this stock, which is Visa, to something like, I don't know, we just pick Bank of America, for example. And Bank of America is, has a lot more swings. It's not a steady uptrend. It's a lot harder to sell a covered call on this because you can lose money on the underlying while you've sold the call and the stock goes down. And great, you made, on your month, maybe you've made 2 or 3% on your call, but then, you've lost like 10% on the stock. So, you're losing money on it. Whereas with the company like Visa or, put up Microsoft here, for example. And I talked about this in a past video about how selecting the underlying makes all the difference, makes your life a lot easier. If you just pick something that's kind of in a steady uptrend. And you could even look at Amazon. Although Amazon is a kind of an expensive stock, and you have to have a decent sized portfolio to do income trades on Amazon. But Amazon is been in a steady uptrend for a long time. Let's just go back to Visa, and let's look at what the structure is of a covered call trade. So options, you have different expiration dates for options, and let's look at the options chain for Visa. And so you get an idea of that. So we have the options chain for Visa here, and this I'm showing the May 17 expiration here. And there's expirations that are called regular expirations, which are monthly expirations, which expire on the third Friday of every month. And then there are weekly expirations on a lot of stocks. A lot of stocks now offer weekly expirations. And so I'm looking right now at the regular expiration for May 17th, the third Friday of May. So we could potentially own Visa, and if we look back at the chart here, we see it's selling for, the close is 157 today, and today is Monday, April 9th. And we could potentially sell a covered call on Visa. Now, I'm not saying this is a great trade right here. It's much better with Visa, for example, to sell the covered call when the stock has a little bit of a retrace to this 10-week moving average. And of course, if the market tumbles, the stock will tumble with the market. But that's another training that we can go into, which is market time. That's what we're talking about here. But the stock best would be to do a pullback, and you can do a pullback to the 40-week moving average. But when the stock pulls back, you're lowering your risk. You're lowering your entry risk. So what we do is a covered call is you buy the stock. So for example, right now it's selling for 157.49, and you sell a call option to earn premium against that stock. So looking at the call options, and let me just shrink that up. We can maybe sell the 160s, which would maybe sell it for, now you're going to try to hit somewhere in between the $284 and the $3 bid ask here. You wouldn't want to just hit the bid. Maybe you can get 290 or 292 or something out of this thing. But you would sell, say you sold for 284. Well, then you get to keep that premium. That this premium will, if the stock goes up over 60, right? You'll just keep the premium and the appreciation in the stock from the 157 to the 60. So you're going to make a little less than $3 plus the premium, which is 284. So about 550 or so, $6. So you potentially make about $556. And by the way, it's 600 because you multiply everything by 100, right? By doing a covered call on Visa here, if the stock goes up and closes over 160. Now you'll lose the stock. The stock will be called away from you, but you'll keep that premium. Now, if the stock falls, of course, you'll keep the premium, but you'll be underwater in the stock. But if you like the stock, which is the point of all this, is you like Visa because it's a long-term good investment, then you don't really mind so much if it falls. You're like, oh, I got to keep the stock, and I also got to keep the premium. So now let's look at the possibility of doing a naked put sell. Now, naked puts can be very dangerous because you have unlimited downside, right? You have, the stock can go to zero, and so you're going to make $2. Like I'll do an example with Visa here. Say you sell the 145 put, and this is we're the May 17 here. So you're going to earn maybe 86 cents, right? But or I should say, it's $86. But you're on one contract. But your downside is, potentially if this stock somehow magically went to zero, of course, Visa, that'd be unbelievable, right? But if somehow magically went to zero over the next 30 days, you'd make $86, but then that would, under 145, because you did the 145 strike here, you would have potentially unlimited downside, so that it would be like $14,500 potential loss if the thing went to zero, right? So the point being that if you do sell naked puts, well, it's essentially the same as owning the stock, right? Because if you own a stock outright, your downside is also 145 points. So what you're doing essentially is you're saying, I really like this stock. I wouldn't mind owning it at 145. So I'm willing to sell the put. I'm willing to sell the put and earn the income. And if I own the stock at 145, hey, I'm really happy because that's a really great price for this stock. So that's the way you have to look at naked puts, right? You don't want to sell a naked put on something like a biotech company where, you could have an adverse news event and, lose your shirt. So that's the thing with naked puts. Yes, your downside is unlimited, but guess what? If you own the stock, your downside is unlimited too. So that's the other thing with naked. So we got selling covered calls and I should say, doing covered call trade and selling naked puts. And the third kind of trade I wanted to touch on is the bull call spread. So we're here, again, we're in Visa, and a bull call spread is simply you're going to pocket premium based on the time decay of the option, and your downside is limited. So in this case, for example, if we did a vertical call spread or bull call spread on Visa, now the stock, if we look at the stock again and kind of see the levels here, right now it's on for 157. So we could potentially do a deep in the money bull call spread of maybe 135, 145. Now I don't know if that's going to be, if it's going to work out right from the numbers, but we'll look at that in a minute. But if we do the 135, 145 bull call spread, what we're doing is we are buying the 135 call. In this case, it'd be the May, whatever the expiration was, May 17, and we are selling the 145. Now, it turns out the 135 is going to have less time premium in it than the 145, because the 145 is closer to the strike price. I'm sorry, closer to the trading price. And so over time, the 145 is going to depreciate, lose its value faster, the call will, than the 135. And at expiration, you'll pocket that difference. So I'll show you what it actually means looking at the chart of the options chain here. So we're doing the 135, 145, for example. And you can see here that the 145, which we would be selling, we would sell it for about, maybe sell it at the worst case, 13.7, which would be the bid, but we'll try to get better than that. And we would be buying the 135 for maybe 23.6, but we try to get better than that too, right? Try to get more towards the midpoint. And so if you do the math and you say, okay, so 157 minus 145, you can see that that is equal to 12, right? And so there's about a $2, about $1.50 or $2 premium on the 145. But if you look at the 135 and you do the 157, which is the price it's trading at, minus the 135 strike, you're looking at $22. And you can see, compared to $2, it's only about $1.40 or $1.50. So there's less time premium in this 135 than this 145. So you're going to pocket the difference. So what does that mean? How do you calculate that? Guys, that's a lot of math, it seems, right? Well, we have actually a handy calculator on Street Smart Options that is part of our course. You get this for free. And it is a bull call spread calculator. We have a number of different calculators. This is just one of them. And I actually input the numbers for I was looking at the 150, 135 for this May 17. So in this case, we're going to say, okay, we have a $100,000 portfolio, and we're going to max risk 2% of that portfolio on this trade, right? So that's going to be our out of pocket is maximum $2,000 if we lose the entire investment. And so we would look at that. The high strike is 150, the low strike is 135, and for the spread. And we're going to be, once again, we're going to be selling the 150. We're going to be buying the 135. This is the price that we would be selling. This is the price we'd be buying. And the calculator automatically calculates for you, okay, how many contracts can you put on this trade for a maximum risk of 2%? And what's your potential annualized gain? Now, we'd like to target over 100%. So this is actually kind of low, 78% annualized gain. It's not bad, right? Our max gain is $110 on this, and our max loss is our initial outlay, which is $13.90. Now, you have to figure what's the probability of hitting the max loss target. Well, we're not going to hold it to the max loss target. If we're down on this, maybe 20%, we're going to get out. So our stop loss is 278 on this. But the point is that this is a high probability trade because the stock can go up, sideways, or even down a little, right? Because this is 150, the stock's trading at 157. And as long as it trades over 150, minus the premium you just got, which is, the $110. So we'll just say 150. As long as it trades over 150, you're happy. You're going to make money. You're going to make your monthly income. And so, and if you pick these, if you time these right, where you pick these things where it's a pullback to a major moving average, like the 50-day or the 40-week moving average, if it's, the market's weak, you can do, it's a very high probability trade. And so you can run maybe, 10 of these trades in a row and have success in every single one, and then maybe lose 20% on one of them. And you'll be pretty happy at the end of the year. But it's all about picking the underlying, which is the really important thing. I want to touch on one other thing. This video is getting kind of long, and that is the amount of premium in these trades, like selling a call or selling a put or doing a bull call spread, depends on the volatility that's in the marketplace. The more volatility, the more premium you can potentially earn. So one thing you can look at, just this is the overall market, is get a sense for what things are, where we are in the overall market. And the VIX right now is at 14, which isn't bad. It's kind of the midpoint for a rising market. Obviously, you can see it spikes up when the market falls. Now, the other thing to look at, you can look at the implied volatility for the actual stock. And I use a site called Market Chameleon for that. You input Visa, and you can see that let me scroll down a little bit here. You can see that the 30-day implied volatility right now it's about 22. And you can look at the historical here, and where do we sit? Well, we sit right around the middle there. So, it's not too bad a place to be putting on a trade like this for Visa to earn some premium income. But that, in summary, three good strategies I like to use, which is selling covered calls, selling puts, and doing vertical call spreads. And you can learn more, and we go into a lot more detail about position sizing and market timing and that kind of stuff in our course, Option Locomotive, which you get as a bonus as part of our Street Smart Options course. So check out our site. We also have a free members area with more videos like this. Okay, Jim, back to you.
All right, Jonathan, thanks for that synopsis and that good lengthy video all about how to do it. So, folks, you're missing out on content like this if you're not subscribed to our YouTube channel. So just give some thoughts to that. If you subscribe, hit that bell icon so you don't miss other great videos like this, because we're dropping all kinds of knowledge over Street Smart Options, located on Facebook, located at streetsmartoptions.com, and also right here on YouTube if you're watching us on YouTube. Have a great day.